Today, I would like us to look at investment in corporate bonds or investment in bonds, not treasury bonds this time, but corporate bonds, using the angle or using the lens of EABL. In other words, East African breweries having received approval by NSE and CMA to release a prospectus for 11 billion. What does that mean? East African breweries wants to borrow 11 billion from the public, from you and I. You see the way CBK has been borrowing money from the public and then paying coupons. And I don't know if you remember me telling you earlier that you can invest in treasury bonds. You can also invest in corporate bonds. Now, EABL is giving us a chance to invest in one such corporate bonds. So in today's episode, I'd like us to discuss what is a corporate bond? What are the silent features of these corporate bonds? What are the advantages, if any, of investing in these corporate bonds? And what are the disadvantages or what are the risks of taking up these investment opportunities? Why is EABL borrowing 11 million from you? 11 billion, I mean, from you and not from the bank. Okay? And what are the differences between investing in EABL as a bond, I mean, lending EABL money as a bond, or investing in EABL shares where you have the potential of earning dividends? Do they compare, and how do they compare? Okay, so if this sounds like information you'd like to know or something you'll be interested in, please stay around. And this is also one of those videos where I tell you, take a piece of paper, because we take a pen and a piece of paper, because it's going to involve some arithmetics. We are going to do comparison between an investor who had taken an investment in the corporate bonds for EABL and an investor who had invested in shares instead. All right, taking into consideration the capital gains, the potential capital gains rather, the dividend payouts and the coupon payouts that we receive from the bonds. However, before that though, my name is Berlin and thank you so much for tuning into this channel. Kindly, please press the subscribe button if you haven't subscribed, and please give me a thumbs up. Also, do leave me a comment in the comment section. Do let me know what you think about this bond by EABL. Is it a take or is it a pass? So let's get started. Now, EABL has received approval from CMA to source for 11 billion from the public. So then the issuer of the bond in that case, or the issuer of this paper, is East African breweries, all right? And the borrower in this case is you or me who is going to invest in this paper or in this bond, all right? The borrower in this case is your fund manager who is going to invest in these corporate bonds. Remember I told you that these collective investment schemes, they do invest in corporate bonds as well. So this is one such bond where your fund manager, your Mansa X, your Oak Fund, your Etika, your other fund managers are likely to take up the investment in. Now, the interest rate is 11.8%. Now, this is coming when EABL has just retired a previous bond, also of 11B, but that previous paper was at 12.25%. Now, an interesting fact, when EABL had issued this bond, this prospectus for this bond, on the previous issue, they did receive subscriptions of 345%. In other words, they were looking for 11 billion, but they received subscriptions of 37.96 billion. What does that tell us? The confidence that the market has in East African breweries. Imagine a company going into the market or coming into the market to look for 11 billion, and then people are offering to give them 37.96 billion. Yes, sometimes we do have oversubscriptions to treasury bonds, but sometimes we have significant undersubscription. EABL received a subscription of 345% for the last time they floated this paper. Okay? Anyway, now that is the last time that EABL floated. Now, status quo where we are at now, it's paying interest at 11.8%. The interest is subject to corporate withholding tax of 15%, meaning that the net coupon or the net interest is 10.03%, right? Now, unlike the treasury bonds where the minimal amount is 50,000, with this paper, the minimum amount is 10,000 shillings. So if you need to invest in this paper, you only need to have 10K for you to take up this investment opportunity. Now, the additionals are in multiples of 10K. So you can invest 10K, 20K, 60K, 1 million, 1 million and 10,000, but you cannot invest 55,000 because 55,000 is not a multiple of 10,000 shillings, right? And for you to invest in this, you only need to have a CDSC account. You see the account that we use to trade in shares? That is all you need to invest in this paper, in the EABL bond. Which are the important dates? It was opened on 27th October. It will be closing on 10th of this month. So we only have from today, the 4th of November, up to 10th of November. The allotment date will be a day later, that is on 12th of November. We will receive notification for the successful bids on 13th of November. The payment date, if you put your bid for this and it's successful, we will be remitting money to EABL on 18th November, and on 20th of November, this bond will be visible on your NSC account, on your CDSC account, part of your shares. And at that particular instance, you will be able to trade it. You can sell it or you can buy more from the secondary market. But from the primary market, the deadline for buying it is on 10th of November. The coupon are paid in May and in November. I don't know why most coupons fall in May and November. Even CBK, many CBK papers have their coupons being paid May, November, and June and December. But anyways, the coupons for this paper is payable on 18th of May or on 18th of November. And when it falls on a weekend, then it will be the next working day. Or when it falls on a public holiday, then it will be the next working day from 18th of November. So now, I told you we are going to discuss investment in bonds vis-a-vis investment in shares. How does this compare? Now, when you invest in this bond, you are being a lender. Unakopesha pesa. You are lending EABL money. However, when you invest in shares, when you go into use the same CDSC account to buy shares, to buy EABL shares, you are not lending EABL money. You are owning EABL. Remember, shares is a portion of ownership of a company. So when you go into NSE, when you use a CDSC account to buy shares, you are becoming a part owner of EABL. But when you invest in this bond, you are becoming a lender, a creditor to EABL. Okay, so those are the two differences. One, you are an owner. Another one, you are a lender. Now, because you are an owner, when you buy shares, you have voting rights. You can vote when they're having their AGMs. But when you buy the bonds, you don't have any voting rights because you are not an owner of the company. All right? So understand those two differences. The bonds, you are a lender, you don't have voting rights, and the shares, you are an owner or a shareholder, and you have voting rights. So then that means the potential for returns as a bond holder or as a lender is limited. Why? Because the interest rates is fixed. We already know that now when you give them 10,000 shillings, you're going to be earning net 10.03 or maybe 11.8% gross return, okay? Subject to withholding tax. However, if you are a shareholder, the return on investment is not fixed. It's unlimited. Why? Because you can actually earn or make losses as a shareholder. How? When they don't pay dividends and when the share prices drop, then you'll have made losses. However, as a shareholder, you have potential of earning dividends. And these dividends that you're going to earn, you cannot know now, not even with their history. In fact, EABL is one of the companies which has been quite inconsistent with their dividends. In 2022, they paid dividends of 11 shillings per share. 2023, they paid 5.5 shillings per share. 2024, they paid 7 shillings per share. 2025, they paid 8 shillings per share. So you can see 11, 5.5, 7, 8. It's neither here nor there. You cannot preempt how much dividends you will be earning throughout the next period of time, okay? However, with investment in bonds, you can tell, I give them 10 million, this is how much I'll be earning. I give them 100,000 shillings, this is how much I'll be earning. Why? Because the interest rate is fixed. So bonds, we have coupons, which is fixed, and with shares, investment in shares, we have dividends, which is variable. We don't know how much we are going to earn. It will depend on the company's performance, and it will depend on how much of their profits will be paid out to us investors as dividends. All right. Now, both investment in shares and investment in bonds, we have potential of making capital gains. All right. And I've told you the return from bonds is fixed, return from shares is variable. Now, as creditors, in the unlikely event that EABL was to go into receivership or to be liquidated, if you are a bondholder, you are an unsecured creditor. In other words, if EABL is having an overdraft at KCB Bank, and KCB has a debenture over their asset, whether fully or partially, then they are secure creditors. So if EABL was to go into receivership or into liquidation, I'm not saying that's going to happen. We don't foresee that happening now because they have a strong balance sheet. But if that was to happen, the secured creditors will be given priorities. And then you, the bondholder, who is an unsecured creditor, will rank after the secured creditors. Now, the shareholders are owners of this company. There is no way that you, an owner of a business, will be paid first your dues before other creditors are paid. So what do I mean? What do I mean? The bond ranks higher than the shareholders in the event the company is put in liquidation. So then it's the bond is less risky as opposed to the shares. That is in case the company was going into liquidation. Yeah, the bond has an investment horizon of 5 years. Why? Because the paper has been floated for 5 years. It matures within 5 years' time. Yeah, but shares, investment in shares is infinite. You sell your shares when you want to sell the shares. You can have it back within 1 year. You can have it back after 10 years. In fact, even with the bonds, you can also sell it before the 5 years. But if you don't sell within 5 years, your investment lapses and EABL sends you back your initial principal that you had invested. Okay, both the bonds and the shares, if you are to earn the coupons or the dividends, are subject to taxation. The bond is taxed at 15%, and shares, dividends from shares, are taxed at 5%. Okay, so those are the different aspects between bonds and shares. Like we have said, the bond, you are a lender. With shares, you are a shareholder. The bonds, you have no voting rights. With shares, you have voting rights. The bond pays you coupon. The shares will pay you dividends. The coupons from bonds is fixed. Dividends from shares is variable. Sometimes they might not even pay. Sometimes they could actually pay more than 11%. Both bonds and coupons have the potential of paying us capital gains. The bond will get the capital gain if you're able to sell in the secondary market at a premium, okay? And you can also make capital loss if you sell it at a discount, all right? 9, with regards to ranking, the bond ranks higher than the shares, okay? And the investment horizon, the bond has 5 years. It matures, you get back your money. The shares, you get back your money when you want to get back your money. You go to the secondary, you go to NSE and sell your shares, all right? Now, I would like us to compare these bonds, the shares and the bond. Remember I told you that EABL had initially borrowed 11 billion earlier in 2021, which they actually prepaid earlier this year, yeah? And then they had borrowed at 12.25%. Now, if I had 100,000 shillings and I decided to invest in the bond, and somebody else had 100,000 shillings and decided to invest in EABL shares, how much will these two different individuals have earned from 2021 up to now, 2025? Now, the share price for EABL back in October 2021, The share price for EABL when this bond was issued was 166 shillings, meaning that if you had 100,000 shillings to invest, you would have managed to buy 602 shares, about 602 shares, of course, depending on how much your broker will be charging you. And the dividends received from this company, from EABL, from then, October 2021, up to now, is cumulative of 31.5 shillings per share. Okay? Like I told you, in 2022, they had 11 shillings per share. 2023, they had 5.5 shillings per share. 2024, they had 7 shillings. And this year, they paid out 8 shillings per share. So the cumulative dividends per share from 2021 up to now is 31.5 shillings, right? So if you had invested 100,000 shillings in the EABL shares, then you would have earned cumulative 31.5 dividends per share, and you would have had 62 shares, meaning that your return on investment would have been 18,963. When you remove the 5% tax, you have a return of 18,014. And right now, EABL shares are trading at about 230 shillings per share, okay? So then if you are to redeem your shares now, you would have, if you are to sell your EABL shares now, you would have earned 138,460 shillings. And there's no capital tax. There's no capital gain tax here. So your cumulative return from your investment of 100,000 shillings would have been 138,460 being the amount you've sold the shares at, plus the 18,014 being your dividend cumulative dividend received from the counter. You would have had earned a sum of 156,000 shillings 474 from investing in shares. How about if you would have invested the same 100k in the bonds? Now, the interest rate was 12.25%, so your interest at 12% for the 5 years, or for the 4 years rather, because they prepaid actually, would have been 47,200 shillings. It is subject to 15% withholding tax. So your net coupon or your net interest on the bond would have been 40,120. And upon redemption, EABL sends you back the initial principal that you had sent them. That is assuming there was no prepayment of principal during the tenor, okay? So you receive 100k plus the 40k, which is 140,000 shillings. So you can see someone who had taken up shares back then would have potentially earned more than whoever took the bonds when that bond was floated. But this might not always be the case. Why? Because share prices are variable. What if these shares had dropped from 166 to 100 shillings per share? Like for instance, now shares are, the EABL shares are at 230. What if it drops back to 100 or to 160 during the 5-year period of time? Okay, what if EABL does not pay dividends of 11 shillings anymore or 8 shillings anymore? They pay 5 shillings per share. Then the earnings from shares is going to be potentially lower. So this is why investment in bonds, this is one of the advantages of taking up the corporate bond vis-a-vis taking up the shares. Why? With the bonds, your income is predetermined. It is fixed. You can actually budget with it, okay? Except in a scenario where a risk arises. And what are the risks? Of course, you cannot be having flowers without thorns. What are the disadvantages of investing in bonds vis-a-vis investing in shares? Now, let's just concentrate on bonds. What are the downside of investing in bonds? What risk are you supposed to be aware of? Number one, there's a potential default risk. Well, EABL is a blue chip company, so I don't foresee them defaulting in their bond payment but corporate bonds are subject. Anyway, whenever you lend somebody money, anybody money, even if it is your mother or your father or your son or your husband or wife, there's potential for default, including treasury bonds, by the way, the government. There is potential. There's a risk of default. The level of risk just differs from one borrower to the other borrower. Like for EABL, I think it's lower, but there is a risk of default. Whether that risk will crystallize or not is something else. There's also a risk of liquidity. Liquidity in the sense that nobody wants to buy the bonds in the secondary market. You are in year 3. The coupon rate at that time or interest rate at that time is higher, is at 14% or at 18% where we've come from, and you're holding a paper worth 11% with a coupon rate of 11%. Do you think it will be easy for you to sell that paper? You'll have to sell it at a discount. And this is the same risk that we also have in treasury bonds, okay? Liquidity risk. Selling that, converting your paper to money might be difficult if you don't have somebody who is willing to buy it in the worst case scenario at par, meaning cent for cent or shilling for shilling, okay? That means that investment in this bond is going to expose you to interest rate risk, a risk that we also have in the treasury bond, okay? You know what interest rate risk means? Fluctuations in interest rates. Of course, you don't want to be holding a paper, an investment that's paying you 11% when at that particular instance, the interest rate is at 14%. Banks are actually paying at 14% on fixed deposits. Okay, so there is a risk of interest rate risk. There's also a risk of call risk. Call risk in the sense that you want to invest for 5 years, and then in year 2 or year 3, EABL has made money from their operations, and then they decide to call back the paper or to buy it back. That's a risk that we are going to be exposed to, okay? The risk that EABL will prepay you. By the way, that risk crystallized this year. EABL prepaid the bond that they had floated in 2021. It was meant to mature in October next year, but it has already been fully paid out, yeah? There's also inflation risk. Remember, at the end of the day, at the end of the 5 years, EABL, if you invest 100,000 shillings, they'll be paying you back exactly 100,000 shillings. So this is a risk that we need to be fully aware of as we make our decision to take up this investment. But what are the advantages? Number 1, it is a low entry point. Low entry point in the sense that for you to invest in this, for you to lend EABL, imagine that big company, you are their lender, quote unquote banker. You only need 10K and multiples of 10K. Now, this makes it an easier investment opportunity for us to absorb as opposed to treasury bonds. Why? Because bonds, you need 50K. For you to top up, you must be having 100K. And for this, you 10K, 20K, 30K, 40, 50, 60, 70. For as long as you have 10,000 shillings, you can invest in this bond. With the treasury bonds, you must have 50,000 shillings or 100K or 150K or 200K, making it a little bit difficult for people in the very, very low income bracket to consume or to take up. But with the EABL bond, 10K, you are an investor in the bond market already. Okay? Now, EABL is a blue chip company. Their financials are all over. We can see it. Their balance sheet is strong. All right? It has good credit history. It's not the first time that it's coming to the market to borrow. It had borrowed before and it paid in time. There has been no event of default. All right? It has a strong balance sheet, like I have said. The investment in the bond will also offer us a good opportunity to diversify our portfolio and to balance our portfolio. We expect this bond to be liquid. Liquid in the sense that because it's going to trade in the secondary market, in NSE, you can buy it the way I buy shares, the way you buy shares. We expect it to be liquid, to be easy to buy, to be easy to sell, okay? It also offers us a predictable returns. Now, I'd like us to go through just a few examples. Remember, like I told you, there's a risk of defaults, which is low, but there's a risk of default with this. What I mean by that is that when a company floats a bond, a corporate bond, when you invest in a corporate bond, at the back of your mind, you need to know that this company is expected to pay you back your interest in time and your principal in time. But sometimes, due to one reason or another, they might fail to pay that. And we have cases of companies that had floated bonds but were not able to pay their creditors. Companies like Nakumatt defaulted in a bond. And in fact, one of the fund managers, Amana Capital, had invested in Nakumatt. They were in trouble because Nakumatt ilizama na pesa yao. Okay? We have ARM at River Mining that had floated a bond and it defaulted in that bond. We had Imperial Bank that had floated a bond and then it was put in receivership. Even Chase Bank was put in receivership and they were not able to pay those bonds. So yes, it is possible for a company to default in paying their bonds, in meeting their obligations, either the interest or the principal payments. And when that happens, your default risk would have crystallized. Okay? Remember, like I told you, given that we are unsecured creditors, we rank after the secured creditors. So in the event of a default, the secured creditors might want to put this company in receivership so that the receiver manager can manage EABL and generate revenues to pay the secured creditors and then the unsecured creditors and then finally the shareholders. So this is all that I had wanted us to know about the EABL. If you have any questions, please don't hesitate to drop them in the comment section and I'll be glad to answer. But this is an overview of the EABL investment, of the opportunity to invest in the EABL corporate bond. The deadline for investment is on 10th of this month. Thank you for tuning into this channel. Let's meet on the next video.